This is how I make money no matter what in the options market. Here we're going to look at a covered call that I sold on LUNR that has gone in the money. And that means I'm now at risk of someone calling my shares away. I sold this call with a strike price of $12.50, but as of this screenshot, the shares are trading at $15.53. And that means that the person that I sold the contract to now has the right to purchase my shares at $12.50 while the stock is trading over $15. That's a pretty good discount for them. I did make $1.29 per share at the time I sold the contract, which makes my break even $13.79. However, the stock is still trading above my break even point. My cost basis on these shares is $7.85. So I'm not really mad if someone buys my shares at $12.50, especially when you factor in the $1.29 premium that I collected at the time I wrote this contract. But what if I don't want somebody to buy my shares at $12.50? That's when I'm going to roll this contract out into the future and try to increase my strike price. My current contract expires in January of 2026, so I'm going to look for a contract that expires later than January 2026 and has a higher strike price than $12.50. When I look at the options chain, I chose March 2026 contracts for $13 strike prices. I'm trying to roll out in time and up in strike just enough to collect a premium or collect a credit. Rolling into March is going to give me 2 more months of time and 50 more cents per share. Here in the screenshot, you can see that the midpoint to roll this contract is 75 cents per share, and that's $75 to roll this contract into a better position. And this is how I make money no matter what with options. I'm going to get paid to improve my losing position by rolling up in time or out in time and up in strike price. And that's not bad.